ICA. Welcome back. I know now that we've put together a bit more of our, fundamental foundation, we understand a bit more about the vocabulary of the markets. We understand a little bit about prices. Now what we're going to do is we're going to go into, the introduction of our options. For the majority of you, you're in this class to try to understand how it is that Chemo and the rest of the Discord seek out these options and seek out these returns. Very, very quickly, you can understand is the main thing where stocks have kind of their own expected movements. They're generally pretty slow, right? Price and, I like to think of it in terms of a vehicle would be public transportation. Everybody gets onto the same prices together, and it only goes to zero if the entire company goes bankrupt. So the risk is limited in terms of the value of what you put in, but the time frame that you have is basically, not unlimited, but for the lifetime of the company. All right, the lifetime of the entire company through history. Now, the thing about options we got to understand is options are part of what we call the derivatives market. Instead of us just caring about price, we now have to consider time, okay? While public transportation or equities tends to have, I like to think of as almost a unlimited length of road. You get on for the price action and it continues. You follow the price action, it goes up, comes back down to the same price. Your profits will be the same or your losses will be the same. But in terms of options, time is now a factor, and it's almost as if you are getting into a faster vehicle, more of a sports car, and you're choosing different lengths of road. So do you only want this road to last you for the day, or you only want the road to be for the next week, the next month, the next year? It's not going to be an unlimited amount of time like with equities. One of the big things to consider too is it's a much more stressful situation because there is the possibility that if time expires, that can also create a situation where the option is actually going to be worth nothing. We'll go through a couple examples in a moment. Now, the upside though is a leveraged, it's a, you can think of as for every option that you actually purchase, it actually represents 100 equities or 100 stocks. All right. And so here, for example, is a trade during the AMC short squeeze, AMC GameStop. And here, the 5 contracts actually represents 500 shares. Okay. It's a multiple of 10. And the cost for each contract is also a multiple of 10. So for each contract here, it was actually $158. Now, as a result, when price does move heavily in the favor that you're in, the returns can be quite ridiculous. In this situation, a 55x return in terms of the options contract that was purchased. Now, with every up, you have to understand that the market here is a zero-sum game, which means for one person to win, there has to be someone that loses. And on the other hand, you have to realize that options, especially with people who, either follow others blindly or also are unfamiliar with the speed at which options can move, you got to realize how quickly things can go south for someone, okay? It's a situation in which the returns, as much as they can be positive, can just be as negative as well. And these situations are plentiful all over the internet. When you go look at something like, Reddit and look at Wall Street bets, and, they call this loss porn. But ultimately, it's not a good situation to be in. And these people are not understanding how they need to be mitigating their risk or managing their risk while they're doing these trades. Now, when these lengths of road, when the contract you have expires and it happens to be the version that isn't worth anything, okay, we'll talk about that in a sec. If it's out of the money, then the contract is worth zero. So, the company can still be around, but your contract could have lost all of its value. Well, why would people want to be in options? Well, it's that quick acceleration component where, for example, here, this is when Amazon was trading in the thousands, 3,000 each. And Amazon was up $100-something that day, which is about 5%. But when you take a look at the options contracts that were offered, you could have gotten close to a 20x return or 2.5x return, so hundreds of percent instead, if you were in the right type of contracts. Okay. But keep in mind too, there's high risk and high reward, medium high risk to medium high reward. The reason that these pay out in that manner has a lot to do with the risk that the people are taking on when they get into those contracts. So they do pay out, handsomely when you're in the right situation. But just as well on the other side, with each of these, there's going to be contracts on the other side that very likely are looking at minus 99%. So, the purpose of options you can think of is a faster vehicle in terms of investment, but one that also creates higher levels of risk with the company, with your investment, with your money. Okay, the options market also is very often compared to the casino, the gambling, and how, because these returns are only situations where you would find with gambling, like playing the lotto. Now, where did options come from? We got to talk about that. One thing that people don't realize is if you're on the Discord and haven't gone through the additional education, the additional sections, you're only focused on the main chat or so, you got to realize there's a lot of information for you to go through to add on to your understanding. So if you're really here to absorb the information, one of the things we're going to talk about right here is the options history. You can quickly go ahead and pause and go ahead and read that real quick and come right back. But basically, what I want you to understand is that history and the history of the Dutch economy in the 1600s and the tulip market was actually, I like to call it the original NFT, right? The original Rolex. You'll notice with a lot of the examples that we use where value or perception of wealth is also used, you can understand that these are situations where money and value flock toward. And one interesting thing about the tulip market was the tulips were originally, the sign of wealth, the fact that you could afford something pretty outrageous. There was a situation where actually a tulip bulb could fetch up to they want to say 100 times, or sorry, 10 times the 10 times the yearly salary of a very skilled artisan. Okay, so in these situations, you could imagine in our world, if a skilled artisan makes about 100K a year, just to use a round number, $1 million for something. Well, we had NFTs that were worth quite a bit as well. And there were also, you can imagine with options and with these contracts that are being offered, there are other ways to invest in those or speculate upon the future price of what they may be worth. Now, what exactly are options, and the history of options was, in order for both the grower and the shop owner, the retail store, to both protect their interests in flowers, or in this case, tulips, there's actually a third entity, or in this case, you can imagine like a bank that comes in and writes insurance policies to exchange with the two different companies. Well, what might these companies be seeking? What might it be that they want from each other? Well, number one, the grower here wants to protect their harvest. They want to protect their sale of these flowers. So for example, right now, let's just say a tulip bulb is $1 each. And this guy, the grower, wants to lock in his ability to sell for $1. So in this case, we're just going to say this guy is going to buy contracts. In this situation, we'll call them dollar puts PUTS. Puts means they want the price, if the price goes down, they're protected. A dollar puts are these contracts in which if the price goes down below $1, they can still sell for $1. So right now, if the price goes down to 50 cents, they can still go use this contract to sell to the insurance company actually and sell it to them for $1 because they've locked in their price to sell. On the other hand, you can imagine that the buyer, the one that's ready to sell to the public, they might want to lock in their dollar value as well. So they're going to go get dollar calls. They're going to say, I'm willing to pay $1 for them at this price, or at this time in the future, April, May, June, July. I'm going to pay $1 per bulb. I want, let's say, 5 contracts of that, which means I'm going to buy 500 tulip bulbs. All right. Now, keep in mind, when the time comes, I still got to go pay $1 per tulip bulb. That's my promised pricing. That's not part of this contract. But what's going on here is that there's the exchange of protection from this third company, this insurance company. Now, what will happen? There's two different things that can happen. Well, technically 3, but we'll talk about the 2 in terms of if price is $1, right? And this guy says, I'll sell at $1. This guy says, I'll buy at $1, okay? If price suddenly goes up, right? The guy that says I was going to sell at $1 can still go to the marketplace and sell for more than $1. That makes sense? All right. They won't necessarily need that contract that they purchased. That contract would actually be worthless, you might imagine. Now let's talk about the buyer. This makes more sense to most people. The buyer here is saying, hey, I'm going to still be able to purchase. The price has just gone up. Let's say the price went up to $2 per bulb, right? All the way down. So now the supplier is selling for $2 now. Well, Mr. Store owner here is going to go to the insurance company and say, you know what? You sold me these 5 contracts. I want to go purchase those 500 bulbs at $1 each. And as a result, they can purchase it for $500. And if tulip bulbs are all $2 each, he can go directly to the market and sell them for $2 each and make that $500 himself. So when price goes up, the buyer that locked in his price is going to benefit. All right, let's go the other step. Now, what happens if price goes down? So price is $1, and now we just went down. This guy said sell for $1. This guy says buy for $1, right? Now price goes down, and this person, right, the tulip grower, they protected their company or their little business by buying that policy. Remember, it still cost money to buy this policy, okay? This policy now guarantees they can sell for $1, all right? They can sell for $1. Now price went down. Let's say price went down to 50 cents per tulip bulb. No, it doesn't matter why, but price went down, and this guy would have lost out on his he would have probably done his harvest for nothing. He would have maybe lost out on his money. But because he has this insurance policy, he now takes those tulips, instead of them to the market where he is going to lose out, okay, he's going to take them to an insurance company and sell them for the $1 that he was promised for those. As a result, he maintains his company. He protects himself, okay? So the original options history, the original reason that options exist actually comes back down to, number one, the tulip market, and a way for these growers and sellers to actually protect their harvest, okay? Now, obviously, tulips might not make the most sense to you right now. I get it. Same with me. Tulips only mean so much. Well, what's an example that might make more sense? Well, let's use Southwest as an example. Southwest actually was pretty smart when gas and oil was only about 50, almost $60 a barrel. They went and bought 12 months in advance, right? They went and purchased a bunch of jet fuel for cheap. What does that mean? So, well, basically, imagine Imagine back when you were growing up and, you know, hopefully gas was still a gallon back then. You know, I might be dating myself in terms of how old I am here. But back when it was $1 a gallon, what if you could go buy a couple of these coupons, right? Coupons that say, hey, each of these coupons is good for 100 gallons at $1 per gallon. All right. And as price went up to $5, etc., $6. Now, these coupons start to gain value because even though when it was only $1, you're not, you might be able to purchase this, but it wouldn't be worth so much. But if it had an expiration date that it was still good for, well, shoot, you could go to the marketplace and you can say, well, hey, I'll take $4 or I'll take less than $4, right? Because that's the gap between it. The $4 profit, you can sell that contract to somebody and get a portion of it. Now, why is it only a portion? Why isn't it the full $4? Because they could just go to the marketplace and buy it at $5. They don't need that contract or that coupon from you. So therefore, as a result, you have to negotiate a little bit. You're still going to have to give them a deal. It's not going to be a full $4. Okay. Southwest, actually, a part of why their business model worked so well for the wanna get away flights actually is because a part of their oil, the oil that they use is actually locked down at cheaper prices. And as a result, they're able to maintain their business model for a certain amount of time. Well, what else do we need to know? We also have to understand that, for us, we like to use a Rolex as an example of, what if you had purchased an option? In this case, we're going to think of just one Rolex instead of 100. But what if you purchased that coupon for the Rolex back in, the early 2000s, for example, and said, you know what, I'm willing to pay, right? Back then, if in 2000 it was $3,000 for that Rolex, what if you were willing to pay $4,000 or $5,000 or $6,000 X amount of years in the future, right? What would you potentially pay for that contract, right? That coupon? What if it was $500 for the right to buy a Rolex for $3,000 in 2010? And as a result, it actually, gives you a higher return, or it's a leverage of your money in this situation. I'm going to give you guys a quick little example in a moment of how that works. So real quick, I'm just going to go through this. If we agree to buy the Rolex at $3,000, which is the strike price, if the current price is $3K, it's at the money. So let's just say the contract for it is going to be $500 for that premium. Okay. Right now, we consider, just for the sake of a generalization, at the money is a medium risk, medium reward situation. It's right in the middle because you're picking the number that we're at right now, which there is some truth that, hey, it's been worth $3,000. It could be worth $3,000 in the future, right? If Google's at 150 right now, it could be worth 150 in the future. That's medium risk, medium reward. It's normal. All right. But if this Rolex right now is worth $3,000, it's never been worth more, and you decide you're willing to pay $5,000 in a couple of years from now, that's what we call out the money. So if the current price is $3,000, we agree to buy at any number higher than that. Okay. The contract will be of low value because it's a guess that it's going to go up, right? There's no guarantee the Rolex will be worth more in the future, but at the end of the day, we have speculation that we believe it will. This one's called out of the money. Okay. You'll see I use the red pawn for that. If it's right now at $3,000, we agree to buy lower. It's called in the money. All right. Traders, we love in the money. We love when out the money becomes in the money. We love when at the money becomes in the money. Okay. We hate it when our in the money goes the other direction. But in the money is, out of these three choices, the lowest risk, lowest reward, and the risk decreases as you go further and further in the money. So if I decide to go with the 2.5K, then I would probably add onto this $500 premium another $500. That makes sense, because that's the difference between the 3K and the 2.5, right? I gotta kind of pay the difference or make sure that I put some money into the Rolex dealer's pocket to make up for that difference. Okay. Now in the money is a little bit safer because at the end of the day, the percentage changes are going to be smaller relatively because more money is being invested initially. Okay, let's continue. You don't want to just think Rolex, you could think Beanie Babies, NFTs, anything in which you can tangibly hold that could be worth more or less in the future, okay? I know these have been doing terribly, Beanie Babies just as well, right? But what if you could, back in the day, say, hey, I guarantee that I would purchase something, well, in this case, for all those Beanie Babies, you would have lost money on all those, right? If you got into NFTs early, yeah, you might have made some money, but in this situation, it might not be a terrible idea if you had a way to buy options on NFTs to say, hey, you know, I'll buy your 8 from you in 10 years for 5K now, right? Because right now they're probably less than that. Well, in 10 years, if there's a chance that that's going to be higher than that, the person will give you what their perceived price of that contract would be, okay? So it's a way of looking at kind of, you know, I'll put a deposit down to acquire that in the future at a set and locked down price with you right now. Kind of changes the way that you might perceive purchasing things too. Does that make sense? Or at least in the situation with these options, that is exactly how this options game is actually put together. So let's talk about this. So that Rolex example, let's say we instead of buying the Rolex itself, we took that and we bought 6 of these $500 contracts. Okay. So why is it 30? It should be 3,000. Okay. So my $3,000 right here is invested in these 6 contracts for 6 Rolexes in 10 years. Let's say the price went up just $1,000. Well, each of these, in a sense, will gain not necessarily a full $1,000, but a portion of it, because the person that needs to come and buy the option, then go exchange it and sell, they want some money for their time. You know, just like that gas coupon earlier, I'm not going to get the full $4 difference between the 1 and the 5. I might have to sell it to you at a little bit of a discount to get you to buy the coupon, if that makes sense. Okay. So I might give it to you for like $3.50 instead of the $4. Same here. I'm not going to get the full $1,000 difference. I might get 900 or I might get 800, depending on how many people are looking to buy that from me. If it goes up 2K, you've got different. So let's say it goes up, and if you had bought one, you'd be happy. It's now worth 6K. You've doubled your money. You've gotten 100%. But let's go ahead and say here, with that, each contract, now you've spent $500. You have to now come up, right? $3,000 times that, $3,000 times that extra, times the 6. Technically, you're supposed to spend $18,000 to buy 6 of these Rolexes. But what's cool about that is right now they're worth 6K each. So technically, $36,000 is what you could sell all 6 of them for. Okay. Now, keep in mind, you spent 18K. You also spent your original 3K. So you also had this added leverage cost as well, but you now benefited 15 out of that. Okay. So instead of making $3,000 off that one Rolex, this options trade with these Rolexes worked out in your favor to give you actually a much larger return, 5 times that you might imagine. So no, this was just saying my $3,000, that contract is at the money, above that is out the money, below it is in the money. And you can just imagine the price is going to be more expensive for these ones versus these ones, which technically have no real value to them. They're just guesses and hopes that it's going to be worth more. This is just to say, okay, well, now you have different options in terms of, let's say this is a cheaper, right? Like you can imagine SoFi, and in this situation, I'm just saying the gas would be in this situation $5.65 here, which is the price. Well, you can go in here and say, hey, I want to buy this in this situation, ATER ticker, and I can get the contract for 50 cents, $1, $1.50, $2. You have all these different options. I get to choose how much time I want to purchase. And then there's going to be an ask and a bid. So I know there was this question about, well, First off, do we open or close? And then at the end of it, do we, ask or bid? Ask or bid is just like any sort of auction place. There's somebody asking for a certain price and there's somebody willing to pay a certain price. Generally, they're going to have some calculation along this table that gives you the average of the two. But at the end of the day, you still have to go into this marketplace and negotiate between what we call here the spread of this contract, okay? The price difference between the two. What you should also understand too, so let's use a quick example of if I was selling in here a PS5, okay, and you suddenly see the prices between $499 and $500, versus if you saw it was between $400 to $500. What does a small price discrepancy say, and what does a big price discrepancy say? Okay, a small price discrepancy shows that we agree more on the price. It's somewhere around $500 here. Versus a larger price discrepancy shows that there's not as much agreement. We're not sure how to price this just yet. We still have about $100 of negotiation between us. And that's kind of what you got to keep in mind here too. Here you've got this guy asking $610 per share. So times 100, move that over. They want $610 for that contract, okay? This one is saying the 50-cent one. So technically, if you imagine exercising and buying 100 shares of this at 50 cents each, they're going to spend $50 on that. So $660 is what they'll be spending on something that right now is about $565, right? Why would they pay an extra $95 here? Is because they're guaranteed to this pricing for this many days. So there's a reason that they would want to pay a little bit of a premium, okay? Because in their case, they're thinking this is definitely going to be worth more than that, over $7, $8, $9, okay? A smaller price discrepancy. So here it's not too, let's find a better one. Here's better. SPY here has a 4-cent price discrepancy, 4.25 and 4.29. So $4 difference or 4-cent difference per share. So that shows that there's more agreement between them, okay? Why would you want to use options leverage? Again, so this one here with SPY, you can see how it might cost, for me to get 100 shares of this, it would cost me $40K, okay? If it were $400 in this example. Instead, if I wanted to have the right to purchase those shares for just the day, I could spend just $325. Now, keep in mind, that's a high risk, high reward situation. If things move in my favor, this could very well be worth much, much more. But in a lot of situations with short expiration situations, this just as likely could go back down to zero, okay? So the at the money line in any brokerage, you'll notice, is always a very distinct area. So right here, you can see $3.99, right here is the at the money price, okay? You can guarantee to purchase it at lower, so further in the money, or go out the money, right? Let me use white here. Out the money if it's higher, right? So here's the idea. If I said I'll pay $400 by the end of today, and the price is $3.99 at the end of today, my contract is worth nothing because it's cheaper to purchase it at the market anyway. So that's where that risk of it going to zero does lie, is at expiration, if your contract is out of the money, okay, it's going to be worth zero. Any questions before I move on into additional terminology?
Now, you saying it's worth zero, does that mean that I lose everything?
You lose everything that you purchased that option for, yes. Mm-hmm. Yeah.
Okay, so I put in $100, I go out of pocket, I now have $0.
Yeah, you go out of the money type of situation. So for example, it's like saying, hey, right now the Rolex is worth $3,000. At the end of the week, I'll buy a $300 contract that says it'll be worth 4K. Well, at the end of the week, the Rolex is still $3,000. Who's going to come to you and say they want to pay $4,000 for the Rolex now? No,
Right.
right? Nobody. So nobody comes after that contract anymore, right? When you buy a contract, you still pay for the transaction fee, even though the contract didn't go through. If you're if you don't exercise the contract, yes, you would still pay your commission fees with your brokerage are still going to exist, right? If they're helping you acquire anything, that kind of thing. Why do some people lose more money than what they paid for the contract? We'll get into that. I have a very specific section of the dangers of options. That a lot of times has to do with either they are promising and borrowing money in a sense. So they're actually putting themselves in debt. They're buying contracts that they don't have the money for yet, but letting the bank front them. And that's why you could lose more. That's something called margin trading. And it's something you got to be very careful with your brokerage not to be doing right now. Because essentially it's to say, let me borrow some money so that, and I'll return you the money if it happens to go over. Okay. But did I answer the question earlier though? If you buy a contract, you still pay for the transaction fee. You still pay for the transaction fee. So for example, to acquire these $500 contracts, I'd probably be paying Rolex something to be drawing it up for me, right? Same with the brokerages. What I think you're also trying to ask is, let's say, for example, I wanted to purchase this at $400 and it closes at $399. Do I still purchase at 400? No, I don't purchase at 400. My contract is worth nothing. And if I wanted to buy 100 shares of SPY, I just go to the market and buy 100 shares from them directly for $399. So
I get what it's happening. The option itself is an item. So me going in there
yes.
and saying, hey, I want $3.99 and it's going to sell by this time, and it doesn't, that's just saying that my item is now worthless.
Yeah, let's use the gas example right now. Let's say, what if I bought these, gas was going up like crazy. And for some reason, I'm just like, you know what? I got to protect my business. If gas goes up past $9 a gallon, that's the most my business can afford. So I'm going to buy these contracts by the end of this month or by the end of this year. If gas is higher than $9, I can buy it for $9. Well, today it's at 4. And my contract says I can purchase that at 9. There's no reason to use my contract. And so therefore I've lost the investment or that insurance that I paid to be able to purchase it at 9. Does that make sense? So you can also view it as, they call it an insurance hedge or hedging against a position. And that's kind of what Southwest did. They use options to protect themselves. Okay. And that's one way you can use options to leverage your money to protect in case something goes wrong. That's originally why it was being used. Okay.
Makes sense.
Cool.
Thank you.
Yeah. All right, real quick. Options or derivatives, you're estimating change. Okay. So as time goes on, what is the overall expected change? And that's what's really tough. Again, just like I said, 60 miles an hour accelerating, 60 miles an hour braking are two very different things. Just like $60 going up and $60 coming down are going to be priced very differently. Also, one way you can think about it too is let's say I decide I want in this situation for the 6th of this April is what this is. And so if I buy an options contract for that day, you can imagine this day is the final reckoning, right? The last day before all close, that final price determines the final price of my contract. You very rarely want to get to that point. We'll talk about why in terms of the time decay. But overall, the goal here with options that a lot of people can't quite wrap their head around is you're trying to benefit from the quick rise of that options contract. You never actually want to go buy the Rolex. You don't actually want to exercise your contract and actually go purchase that equity. What you're simply doing is you think something is going to go up in price, you get the right contract, the price does go up, you get out of that contract having made your money and you move on. You're simply using the perceived value of that equity in the future to help you profit as well. Versus with equity, a lot of people have the I'm going to hold till my hold this till I die. I'm going to pass it on to my children type of thing. And while that may work for certain types of equity, it is the wrong type of move when it comes down to options. Options, you need to be monitoring, and you need to understand that at the end of the day, they move extremely quickly, and locking in your profits and all those types of things come down to little psychological games that you may have to understand for yourself. But let's